No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking a little bit about investing today. This is it's kind of interesting. In fact, I did talked about it on an earlier show, I think a few weeks ago, with regard to the stock market. A lot of people were nervous about what impact the election was going to have on the stock market and what that would, of course, how that would impact their portfolios. Well, this was I found some research on this, and I shared with you, in fact, then, first-year tendencies of the stock market based on whether the incumbent party retains the White House. And this was kind of interesting because it showed that when the incumbent party wins, okay, the average in the first quarter, the average Dow gain was like plus 7%. In the second quarter, plus 1.5%. In the third quarter, plus 2.8%. In the fourth quarter, plus 1%. So you're looking at basically about 13, 14% gain in the first year if the incumbent wins. Now, if the challenger wins, interestingly enough, it was saying that you'd see in the first quarter a -1. Well, look at us. We in just 2 days, I think is up about close to, it's over somewhere between 2 and 3% up just in 2 days, let alone first quarter. Same thing, second quarter would have been negative, and then it becomes positive after that. So it was kind of interesting how this election cycle, among other new historic things that have been that we've seen, the market is another. All right, the market reaction, in fact, has though it started out, and it was very interesting late election night when you saw the Dow, and in fact, all these triggers happened to stop the bleeding, so to speak, on the market because the Dow was down almost 800 points. S&P, everything was looking like we were in for a catastrophic open the next day. And then what happened? By the time, just before the market opened, it was a -2, I think, 200. Ended up opening -200, but by the end of the day, it was up 200 or more. So who knows, right, how to figure these things out. And this was one of the things about the nervousness around the market. Now, I remember talking to clients through this whole thing and saying, I'm not, everything I'm looking at, it's going to be static either way. So if you look at the research, it would show either we're going to have a positive and then it'll trail off and normalize, or we're going to have a negative and then it'll trail up and normalize. Either way, it's a short-term thing, not a long-term thing. The things that we were more concerned about are what's going to happen with regard to policies, regulatory policies, things that are going to improve our economy, and that's going to be beneficial to the market. And here's some other things. How you invest then in these type of environments. And by the way, one of the things I've also counseled with clients is the thing to really watch is what's going to be happening towards the end of the year when the Fed looks to, in fact, increase interest rates, as they've been giving us lots of advance notice to expect that. So I would expect that at least by December we would see a 25 basis point, probably a 0.25% increase. Now, what will be very interesting to see from that, if you look back a year, in December of 2015, there was a 25 basis point increase as well. And you may recall that when they did that, the Fed said also, well, we're also going to probably do that about every quarter of 2016. In other words, not only did they raise rates by 25 basis points, it's 0.25%. Isn't a great deal, right? But they also said they were going to, broadcast out there. Basically, they're going to do the same thing each quarter so that we'd end up with about a 1.25% increase in rates, starting to finally normalize rates and get away from these accommodative policies. Well, that was what they were saying. The market swooned on this news and, in fact, had about a 10% drop over that next approximately 4 to 6 weeks. So what does that tell us? And then, by the way, and then the Fed started backpedaling. They said, oh, no, we're not going to raise, we're not going to continue to raise rates. It's going to be based on policy, or, what the numbers show us. And, and they were, Janet Yellen was on Capitol Hill being grilled a little bit, and in her testimony was saying, she was asked, well, what about negative interest rates like some of these other countries are doing? And, well, we've looked at that, and we may revisit it. And, I mean, they totally reversed. So the markets thought, okay, maybe things aren't so bad, and the markets recovered from that period. All of this, all right, what does this mean for you when you're investing? The key to investing is we're trying to get a market return. And one of the traps to investing is thinking that, in fact, the market return okay, that we can beat that. And this is one of the myths of investing, in fact, has to do with this ability, and this goes to a bunch of things. I'm going to try to get as much in as I can today. So we might talk a little bit about active investing versus passive investing, what those two terms mean. We're going to get into the science of investing, and that, by the way, is about passive investing. And I'll explain that. All right, this is how to buy the market as opposed to those that are out there trying to find the winners and pick the winners and losers to try to beat the market. We can also, if we have time, we may get into some strategies, but mainly I want to get into a little bit more about portfolio design and understanding how the markets work. You know, in my book, 7 Steps to Financial Freedom in Retirement, I get into, in the first chapter, I talk about, you know, getting your nest egg ready to hatch. So this has to do with what do you do when you're trying, you know, the basic financial planning that goes into determining how to invest. So let me give you an example of this. For instance, before you can really know how to invest, you need to determine the target. All right, too often, and I did the same thing. When I first got my securities license 20 plus years ago, one of the things that I was trained when in getting that license is, and for the broker-dealer I worked for at the time, was that active management was in fact the way to go. That these money managers that ran the mutual funds, they knew which stocks to buy and which ones to avoid and how to get you the best returns possible. And I was, you know, that's the way I was trained. That's what I believed. What I came to find out over time was, though, in that first year or so, as I'm showing these proven performers, that the list of mutual funds that were provided through a broker-dealer to my clients, and then when I would be doing reviews, the quarterly reviews with them, I would be really bummed out, like, what's wrong? These are underperforming the market, not outperforming the market. Why is that? So then I thought, well, you know, I'm going to get my own software, and I'm going to design my own portfolios. I mean, it's you know, I'm going to pick the best of the best. So I'm going to look at the top mutual funds based on their 1, 3, 5, and 10-year even averages, and see which ones are beating the market. And I would pick the top ones we did it with asset categories. So I would look at small companies like small caps, large caps like an S&P 500 index. At that time, I thought mid caps also, let's throw those in. And then we would look at the fixed income. So I would look at the best in the fixed income side, and I'd put together stock and bond portfolios. The standard was, you go in, you talk to a client, you do an assessment of, you do what's known as a risk tolerance questionnaire to determine how much risk, meaning if the market dropped 10%, would you take all your money out of the market, or would you invest more in the market, as an example? And if the person was comfortable with a 10% loss and they would stay invested, then you would ask a question in a different way. Well, what if you had a 15% loss? Would that make you nervous? Would you cut back, move more money into bonds? What would move it into cash? And again, if they were comfortable with 15, then we would go to 20 and so on. You try to determine what their risk tolerance was. Once you had that determined, then the goal would be to put together a portfolio. The stock bond mix was going to be based on how comfortable, what kind of risk tolerance they could stand, because you were going to try to maximize your returns based on that risk tolerance. So that was the goal, because we felt we're going to be judged by how much money I can make you. All right, that was the premise. And so therefore, I've got to find out how much risk you can handle, and then I'm going to try to maximize returns accordingly. Now, that was then. This is now, and I'm going to share with you a better way, all right, when we return. First, a quick break. When we come back, I'm going to show you how that's evolved and how now we can make you the return you need, and we're going to talk about how we get there. All right, so join me here. We'll be right back on the Retirement Report.
This is a Storm